Good afternoon. We're about to commence the second half of our afternoon session today, and the professor has quite an exciting subject up in front of us on trading the basis with using gold and silver options. So without further ado, Professor Fekete.
Thank you. There developed a very lively discussion during the break here, and we decided to continue with that discussion because this is something very, very interesting. I was expecting to do that, and then you see, that's what the financial crisis does to our little planning here. Then I backed off, and now it seems to me that there is interest in the subject, so we are going to pursue it, at least to the extent of part of this slot. The topic is understanding the gold and silver option markets. Now let's simplify it and just stay with gold, because basically everything what we can say about gold can be repeated for the silver. So we are going to talk about the gold option markets. In what way are options different from futures? Well, a future contract gives you the right and the obligation to deliver gold at the stated price at the time of expiry. So it's both a right and an obligation. Whereas an option, a gold call option, is the right without the obligation, which makes it very attractive to a lot of people, because they realize that if you have a long future position, then you can get margin calls and your losses are open-ended, just as your profits are open-ended. This is not the case with an option, where there is an option premium which you can lose, but you wouldn't lose no more than the premium. So it would appeal to conservative investors who like to limit their risk exposure. And these are the call options. In other words, a gold call option gives you the right without the obligation to buy at a set price between now and the expiry date. But that's only half of the loaf. The other half of the loaf is a different kind of option. It's the put option. And the put option gives you the right to sell at a predetermined price without the obligation. So there is also an appeal. Those who would like to go short but would want to limit their risks may look at the put options. And the interesting thing is that you can go long and short on both types of option. In other words, you can buy the call, but you can also sell it. And that is the strategy which comes in when you are talking about covered sales. You are covered short positions, which means that you own the gold and write a call option. By the way, the words selling a call and writing a call are used interchangeably, right? It's just another way of saying it. So when you have the gold and you sell the call, which means write a call option, then you have a possibility of earning a return. And this is actually, it seems to me, the preferred method of people trying to generate an income on their holdings. There was a little discussion during the previous period, and I asked this question of Brown, whether this option market here, it's in Australia, this option market, right?
Well, it's really, we're just trading on behalf of clients with a bullion bank, so it's really a London, it's effectively
Oh, it's a London, okay. Okay. I asked the question, are very short expiry options involved? And the answer was they get away with. This is actually what you would need. But you see, options are approaching expiry all the time. So it's always possible to do this strategy if you want to generate a gold income on the gold holdings, physical gold, and I think the subject is certainly worth looking into. So that's what we try to do. Now keep in mind, when you buy a call or buy put, there is no margin requirement. You just pay the premium, and that's the limit of your liability. You can lose the premium, but not more than that. And the gains are open-ended. So this, on the face of it, looks very attractive. But of course, you have to be careful because there are lots of pitfalls, and I don't want to go into that. However, when you are selling a call, in other words, writing a call, or selling a put, in other words, you are writing a put, then there is a margin involved because there is a liability that your liability is not limited the same way as you have when you just buy the put or buy the call. Okay, now I add one more thing, and then I just ask Tom to relate all this to the basis. We agreed that he will cover this, and then there will be a discussion and debate on that. If you have a bullish strategy, if you want a bullish strategy, then you can do two things. Either buy the call, the gold call, or sell the gold put. Both will give you profits in case the gold price goes up. If you have a bearish strategy, then you again have a choice between two strategies. One is to sell the call, then you are speculating that the price will go down and then you will profit, or buy the put. Now these are not identical, but they are elements of, as I say, bullish or bearish strategy. So that's just a very, very elementary notion which you have to understand before you go any further. It could become a complex subject. We are not going to pursue it to the bitter end because that would lead us too far. However, the relationship between the option market and the basis is very interesting. So I'm asking Tom to take over and discuss that.
Okay. The way I'm going to do this is demonstrate perhaps a strategy that we might actually be able to use today in the market. Recall earlier we said that perhaps one strategy involving trading the basis would be to go along the sort of a spot price short the futures, and then wait until that there's a difference there, the contango, which may be 4%, and then wait for that to shrink, and essentially sell for a profit when that shrinkage is taking place. But that's not something we could do now because of course, we're near 0%. So, unless we think things are going to go into deep backwardation, perhaps you might think that the strategy would be to do the opposite. So this is actually Larry, who I have to kind of thank partially with his constant questioning on this one subject that I don't think we fully understood all of the impact of it, but there is in fact one way to do this, and it involves options, and I think it demonstrates sort of what type of things you can do with the basis when you fully understand it, in sort of a pretty sophisticated trading, but when it comes down to it, it's actually relatively simple. So start out and draw this. Okay, I'm going to use an example, but maybe let me back up before that. So this strategy would be essentially to be long the futures as sort of a proxy for being long gold. So you could think that you've got a physical gold or silver position, but in fact, if you're long the futures, it is it's sort of a proxy for it. And the best way to sort of say that that's true is that when that futures contract comes into expiration, you can actually take delivery on the underlying gold and silver under that contract. So I'm going to say that I'm going to go long futures, and I'm going to use a price here. Let's say that's $7.50. Okay, now let's just say it's one contract, so I'm going to use gold. 150 pounds gold nickel mix. So this is pretty basic. Obviously, the price of gold goes to $850. You've made $100, or $100 times $110,000. If we were to do this in terms of the standard basis trade, as a spread, we might say, well, this futures that I'm going to go long is, let's say, the December 2008 futures. That's $7.50, and let's say then I might go short the March 2009. We've done this before, but just so that we see how that works, let's say that's trading at 760. Okay, and then as sort of this comes into expiration, we would want to see this price increasing relative to this price. Now, it could mean that both prices have actually fallen, but if that happens, we want to see this one fall less than this one in this case. So you're really looking at closing the gap between the 750 and 760. Okay, but let's say now that instead of doing this, because this gap may be non-existent, meaning that the March 2009 might be 750.5. So there's not a lot of gap to close. There's no money to be made. But we think about options as sort of what we've said earlier as a valid strategy here. So we find a December 2008 call option. And I'll use, let's say it's a call option at $800 strike price. Meaning that if you're long this call option, if you purchase this call option, you will make money on it if the price of gold at the expiration, or while the option is still prior to expiration, if the price of gold is above 800, you make $1 for each dollar that it's above it. And these call options are really for the same 100 ounces because, and we don't need to get too far into this, but really when you buy a call option, actually what you're doing is you're buying the right to buy the December futures at $800. So clearly if the price of gold is $820, then you have the right to buy at $800, you have that $20 gain. So here we have the December 2000 call option 800 strike, but clearly we're not going to try to buy it because we already have this long position here in the December 08 So what we want to do is to create the spread or the basis trade, is we need to be short on this side. But now let's look at what it means to be long and short here. If I'm buying this, I'm paying a premium, and let's say this premium, I don't know what it is exactly, but let's say it's okay. So this call option is going to cost $2,000, which means that I have to pay this up front, and then if the price of gold trades above 800 prior to expiration, which is last week of November, I will make some money. But if gold doesn't trade up to $800, I'm going to lose this entire premium. Okay. If gold only trades up to 820, say expiration 20, well, then what happens?
Break even.
Yeah, we just broke even. So really, you have to factor in the premium before you can start celebrating when the price of gold is above 800. An example of this that's pretty funny is one time, me and a bunch of friends, I used to go to the tracks to bet on the horses a little bit, and found this one race we thought we're so smart. There's five horses, and we somehow managed to pick a trifecta. The trifecta is basically picking the first, second, and third horse in order, win, place, and show. And we combined all the horses in order, and it cost us like $12. We said, "But we can't lose. This is amazing. I mean, look at this trifecta pays all this money." And that if you add up all the different possibilities of the trifecta winning, it was like $9.
And you pay out 12.
And of course we won because we picked every combination that we could of the horse. But we were celebrating running around, and then we said, "Wait a second, this was a horse track making money." So we didn't even go to cash. And I had the horse, I've been doing horse racing for a couple of years, and I was with my friends, and said, "Oh my God, I gotta pick this up." So this has happened to me 2 weeks ago.
So now he's in climax.
I forgot what I paid for the option, and I saw one in the money. I was so excited that it didn't work out. So this is pretty important, but it's the interesting thing here, though, is that if you're, so if you're buying, you pay this, but of course, if you're selling or writing in the call option, you get this.
Yeah.
So what you've done, though, if you forget this part and you sold the call option, you get the $2,000, but if gold goes above 800, you now have a liability for that, and if it goes above 820, this premium that you earned up front has been, sort of fully offset, and of course, if it keeps going up, you're going to lose your shirt. But this is interesting, though. If you have this futures contract, for every dollar that gold goes up, you make money here, okay? And for every dollar that gold goes above 820 here, you lose $1. So in effect, you can see how it's an offset. But it's better than that, right? Because what happens if, let's say that, I'm trying to think, what is the maximum? Could you do calculations? What is your maximum gain here?
Oh, it's $70.
$70, right? Or 7,000. Yeah. So, isn't that right?
It's $70 from 750 to 820, and you lose the 2,000.
So if it's at 820, so if it expires at exactly 820,
Yeah. Okay.
right? Actually, it'd be 800, right?
Yeah.
So
Right, yeah.
it would have to expire. So if at expiration the gold price happens to be exactly 800, what you've done is that from 750 to 800, you've made $5,000 on this long futures position. And then since it expired right at strike price, you don't owe anything on this call option, but you get to keep this $2,000 premium. So you've made $7,000. Now, if you just held gold outright, then you would have made $5,000. Right? So we can see how, in effect, this premium becomes the income that you earn on gold by essentially, what did your advisor say?
Sell short.
Short.
Option, so
Options, okay.
Yeah.
So that's what we're talking about here, okay? Well, here's an interesting thing. This alone, but I've done this quite a bit myself. And usually the way I do it is that I have what I think is a peak price. So I don't think the price is going to go above a certain level. So I'm pretty confident that I'm going to earn this premium. And in any case, you can earn the premium regardless, aren't you? Or you
Well, if it goes up over 750, you are.
Right, right. Well, you're going to earn the premium regardless, even if it
That
goes below
premium,
750. So the other thing this does, aside just from the basis, is that let's say gold goes to 700. Let's say we're unlucky. It's down to 700. We're still better off because you've lost 50 on the futures, but this.
3,000 down.
Yeah, you're down 3,000 because it's 100 ounces, but you're only down, so it's 5,000 on the contract, but you've made 2,000 on the option. So this, in effect, and we were trying to draw this chart of how the values change, but it's way too complex. But in fact, this is clearly better than what you would have done had you just owned gold outright. And in fact, at all points up until 820, right? You would be better off by having futures and selling the call option.
So that's what you call covered writing.
That's right.
Covered writing.
Covered call, what I call a covered
It is, but the interesting thing here is that this, and this is what Larry and I think we weren't really connecting on, is that if you have a gold position, you could essentially make a loan to yourself or borrow some gold from yourself and put it into these futures and generate an income which would be $2,000. And this example is maybe not realistic, but you could, that's still substantial. And in fact, pay yourself enough at a minimum, and this is the goal, I think, of many traders that do this, is to cover the storage fees. And if you've got 1,000, 2,000 ounces, you may be storing it allocated basis in equipment or whatever. So if you can cover just the cost of storage, that is in itself a pretty significant thing. But it's very possible you could do better than that. And I'll explain in a second when you might be able to do that. But are there any questions so far on just this? Yes.
Under what scenario are you going to lose? Or are you telling me this is a sure, you just can't lose it?
You're going to lose money if the price of gold keeps going down because you're long on the futures. But if you consider that, let's say you had 1,000 ounces of gold, you sold 100 ounces, and then you used that money to fund this futures account and full margin, then in effect you haven't really lost anything, because had you held that gold physically, you know what I'm saying? You'd still be down. So on a net basis, you haven't really lost. But of course, when the price of gold goes down, we all have unrealized losses.
Can you take a look at it?
Did that answer the question? I don't know if that. So if the price goes down, you lose money on this deal, but you lose money by owning gold if the price of gold goes down.
Yeah, but so in the event of it going down, your losses can there's no limit.
No, you gotta go.
No.
Yes.
But
If the price
you
just
could do a
keeps on
stop
going
loss,
down.
but then you're adding something to this. If you were just to simply say, I had 100 ounces of gold, and but here's an interesting thing though, is that your loss is not unlimited, because gold can only go to zero.
But that's what I'm saying.
You wouldn't be doing that.
It could
But
go
realistically-
a lot further than what you anticipated. So
It could, if that's
your
true.
losses can actually add up.
It could, but the problem is if you have stop losses, then you're faced with the decision of when you re-enter the trade. So let's not get into that, because again, that's a trading strategy. But realistically, you might say that the bottom is might be like 250. Okay, I mean that was the bottom in 2000. I would think that in the worst case scenario, does anyone here think? I mean, that it could even go to 250. But even if you just said, let's say it's 250, there's something this does for you though. By setting some bottom that's whatever it is completely ridiculous. See, you don't have to have full margin on this, right? Because you can have 1,000 ounces, sell 100 of it to fund this account, but then only keep 50,000 $750. If 750, if you had this full margin on this gold, there'd be $75,000 of margin sitting in this account. But since you think the absolute bottom is probably going to be 250, you only really need to put 50,000 in. So with that other 25,000, you can either buy gold back, buy 25 ounces, or you can invest it or take a vacation or whatever you want to do.
Or you could buy back your 100 ounces at 250.
True. Very good point. Yeah, that's excellent, right? You went to 250, you lost all of this, but you kept you kept that money. That's actually a great idea.
So let's hope gold goes down.
So, but you're right. That actually would work. Here's the thing, though. So this has the components of what we talked about here, but here's where it may get a little bit more interesting. In the scenario we are at now, which is near sort of the contango being very small, almost backwardation, because as we recall, when that's the case, what it really means is that the futures price and the spot price are pretty close. But when we have a build-up of contango again, that means the futures price is higher. And if, let's say, the spot price is $750 today and the futures price is $750, and that's now the contango is like, well, let's say 0%, and then we build back up to 4%, but nothing happens with the spot price, what would happen with the futures price? I might have totally complicated that. It would go up by 4%. So 4 times, what is this, 28, 30? Again, I'm trying to do math here. So it might be
$30.
780. Now that's an annualized, so this would have to be like December 09 futures. But and that might have been the one I should have used in this example. So simply the contango returning to its own sort of maximum level without the spot price even doing anything would mean that the futures could move. This particular futures contract could go up $30. Nothing's really happening. The spot price, look at Kitco, it's absolutely dead. Futures price is back. This is going up to 780. It's not clear to me, and it's very possible that this is not factored into the price that people are willing to pay for options. Okay, and this is important because if this price is like now 4% contango, and so you're at, let's say, 780, and nothing is happening, with the spot price, it's possible that this premium would maintain a relatively sort of stable value. And then if the contango is built back in and goes back up to 780, if this goes back down to 750, it's possible that there wouldn't be a very large decrease in this. And of course, when you're selling a call option, you want to get the most that you can for it. Okay. So, and I haven't really done all the math on this, but it will occur to me that even though this strategy by itself is this is the bull and bears. I don't know if you guys have read Professor Worth Bull. What I just described is really the bull and bear skin, meaning you see traders with this short position, but really what they have is also a long position. And I would bet that there's actually long futures that a lot of these supposed shorts have. And we mentioned this earlier, and this is precisely how they would do this. But beyond that, if we take into account that we have this contango that could shift from like a 4% to 0% back and forth, this strategy to me would make much more sense when your contango is the lowest, because your futures price is the lowest, and if the contango is to increase back up, this futures price would go up, and of course you'd be making money on this position, but it wouldn't go up so much if you put the exercise strike price out so far that it wouldn't be in the money. So in this case, you actually, for this example, 780, you might have said the strike price is...
Well, we'll just leave it at 8 and just made $5,000.
Okay, but you can maybe do better because you can set it at 780,
Yeah.
and you might make 3,000.
Yeah.
You might get 3,000 for the.
So it's 3,000 up at the top, you pay 5,000 altogether.
No, well, no. You might get $3,000 of premium
Yeah.
for this contract. So you just simply see how you set your you buy the strike price that gets you back, the futures price gets you back
To the container.
to the upper band of the contango. Okay, that might be an ideal level to set this at. And even if that doesn't happen and the price of gold goes up, you're still going to make the 3,000 plus the 3,000. Unless, of course, it goes up high enough, then you're going to make at least the 3,000 that you would have anyway on the contract. And if the price goes down, you've lost 3,000 less than what you've lost. So I think this is one strategy that could be immediately employed by someone that already understands these things. If any of you are planning to do this, please do it with a broker.
Unlimited risk.
No, because you're long futures. So you're long this. When you sell the call option, it is short, but it's a spread, right? It's the 750 or 780 and the strike price. You're going to make that money regardless if the price goes up. And then once you get above the strike price and plus the premium, you lose $1 on this, but you make $1 on that. So they fully offset. So you don't want to just do this one. Never. I would never recommend doing this one outright. This is not good. People do this and then they get into really big trouble. The only way to make money off of this, I mean, the professionals do this, but some do maybe sell this on a naked basis, but you really got to know what you're doing because it's very easy to be run completely flat.
If you're effectively wanting to buy gold, that's a good strategy because you're talking about the loss. Now, if you bought the gold outright at that price goes down, you make that paper loss, you don't sell it. So that's the same effect here. You're effectively buying it. Now you're talking about a margin call. You're not actually paying that full amount until the exercise time?
If you had a margin call, I mean, I would say just avoid the margin call by funding enough in this account to take it down to whatever you think the minimum price is. But if you think you're a little bit, if you think you can, sometimes a margin call, oh, you got a margin call. Okay, I'm going to wire the funds. 2 minutes later, you're out of the position. So if the market is moving fast enough, you don't have a chance to actually even react to the margin call. But if you think that you're fast enough, you can maybe keep some of that money out of that and put it into, I don't know, I mean, keep, yeah, but but anything that might earn interest or whatever else, or as you were saying, if you sort of keep it. And because you may want to keep some cash now because you think if the price does go down, then you could buy it back. You have money to buy back 3 of these contracts at $250. I could take to keep all the 75 or 70,000, and it does go to $250. There's the thought. If we buy 3 of these contracts, this is hopefully bottom, or we're all bankrupt. If we go down to like 100 or 50, some of us are not going to have enough to eat, I think. But then you can buy 3. And if it goes back up, then then you've made way more than you've lost on the way down. So there's different strategies that go ahead.
In a way, your losses if you make money. I did this a lot with BHP a number of years ago. And what you lose if it goes up is the fact that it can go up higher than what you're going to make from the premium. Plus, well, you don't sell it for more. You're actually just buying it. You make it from the premium, but you're actually missing out on some of the up.
That's right. So I would never say you would take all your 1,000 ounces of gold. That's what we started out with saying. You take 100 ounces of your gold, or 200, or whatever is enough to make enough income off of this to cover storage fees, an annual vacation, whatever it is that you would want to generate income off of your gold. Okay? And you might only want to do this if this. I'm sorry to interrupt, but only when the contango is maybe lower, because I think you've got a better chance of recovering that contango. Whereas you might do the spread trade that I explained earlier when the contango is high, meaning you would go long the futures and not short the call option, but short a further out futures when the contango is high. And then when the contango shrinks, you sell that, or you buy back this futures here, and you short a call option and wait for the contango to increase back up. Remember earlier I said, gosh, I don't think there's any sort of strategy to do the other way, but I think I was actually wrong. I think this strategy, which is something I've used myself, in different ways, but never, you know, I never kind of thought about it in terms of, even just this, you can look at it, this is pretty basic, but when you include this idea of the basis, I think it could be a very, very powerful mechanism. And I'd have to really, I can't really say how much of this, you actually get back, but I think it would be pretty easy to test this and find out pretty quickly.
Should December 2008 be a put option?
You're selling.
So we're selling this. This is we sold a call option.
Oh, it's all call.
Yeah, sold a call option in order to.
Selling the options.
Yeah, we're selling the options
Oh, right,
so that we get the premium here because this is our income.
Right. Yeah, you're selling.
You know.
Sorry.
Yeah, exactly. This wouldn't work the same way if you bought a put option because you don't want to be paying. You want to be receiving. You know, you want to be receiving income.
Sorry.
Yeah.
The best time for these to work is where the actual price of, or share price, but gold price remains reasonably static, and then this is a great way of generating income. And the other question is, where can you do it? Where can you buy options for gold in Australia?
You open up a U.S. account.
You don't have to use account, right? Would this be something that you could sort of replicate?
Yeah, we've done it, but to be honest, we did it for this one client, but you know, we don't have a proper computer system. It's a simple buying-selling computer system, and so we're in the process of actually getting a proper treasury system, which will have all the sort of valuation and mark-to-market functionality, and then I will certainly be pushing internally that we make it available to depository clients that, you know, that they can then buy options on gold in Aussie or US dollars and do forwards or whatever to a select limited sort of, not marketed to every single client. But yeah, I mean, they will be at least, you know, you'd have to be buying 1,000-ounce option contract would be the absolute minimum, and the premiums on those can be $10 an ounce. I've seen premiums down as $2 an ounce, up to $10 to $50 an ounce on at least 1,000 ounces. So you need, it's at least a $10,000, I would say, $5,000 to $10,000 premium that you'd be generating or risking if you're buying. So it's reasonable bets.
Maybe another idea would be are there warrants or options in some of the gold mines? And I know that's not an exact thing, but there's also the ETF here, I guess. I don't know if there's warrants or options on the ETFs, but you wouldn't have the margin, but you would still essentially, you know, be doing the same thing to some
There are
extent.
some Australian brokers that do have futures accounts where you can trade COMEX futures in Australian dollars. You just have to inquire of your broker if there is anybody.
I know one, but you have the option of keeping your account in US dollars or Australian dollars. You keep it in Australian dollars, if the exchange goes against you, they'll give you a margin call, which is very annoying because you bought an option. You shouldn't have a margin. So just to really confuse the auditor of my super account where I do this, I keep that account in US dollars.
Exactly.
That's a good point. But you know, the other thing too is that you would never want to do this like with some automated broker if you're not familiar with this, because it's pretty easy to mess up on these things, selling or buying, and you enter a market order, or you get the wrong period, and you can really make a mess of something like this. You know, if you haven't done it for a while, I would recommend that you start this out with, you know, and discuss the strategy with the broker, and you know, go from there. Now, obviously these are full service brokers. Okay, so okay. Any other questions on this particular? Got everyone thoroughly confused, it looks like. Okay. That's fine.
I guess it's not quite a question, but in my mind, when I thought of covered short, because I've never traded futures, I thought that you're covering your short position, whether it's in futures markets or in the option market, because you have a physical. What you're talking about here is a covered short using futures. Right, you're long futures,
right,
and you're short options, you're short market.
Yeah, and but really, I mean, this is still, if you consider sort of, forget the physical, you just look at long, and so you're, you know.
You can do this using simply physical.
Yeah, you could do this same thing, in effect, by placing physical gold, and the only problem is going to be is that there's going to be a margin requirement on this. Well, I guess there'd still be here, but you'd have to really come up with net money. Because when you sell, a call option, there's it's essentially a short position in futures, so you have to have a margin on that. And of course, if this is the only side you have, if it starts going, that's $900, $1,000 gold, blah blah blah, you're gonna have to sell your physical gold, somehow get it over to the futures account before the, so a lot of the time, literally margin call is like 10 minutes, or 20 if you've been with a broker for like 20 years, maybe they'll give you a few hours, but, so this would be a pretty dangerous way to do it. Unless you had this gold there at the warehouse, at the storage warehouse like COMEX, and you were comfortable with doing a transaction called an exchange for physicals, where you could take your gold and call up the broker and say, is there anyone that wants to buy gold? And then what you would do is you would transfer the gold, and you create a long futures position and replacing your long physical gold position. Too complex, not something that your average trader is really going to be able to do. So this really would be, I think, the way you'd want to do it in order to do this strategy. But especially, you won't get this ability to recover the contango unless you're using futures. And you could even use, I said December 2008, but you can use December 2009, and then you have even a larger movement in these futures. And in fact, under the call option, of course, you can earn even a larger premium. But what I'd have to see, and I think there's probably a point at which this ability to move, to have this contango to get recovered would sort of go away at some point. So I think I'd suspect that this is more likely to occur in the more nearby futures. Yes.
If you go with your futures a year out, wouldn't several options expire by that time, and you'd have to, you could write another one in theory, like another 2,000, another 2,000.
You could use the December 2009 option.
No, but why would you want to? If it expires in December 2008, you kept your $2,000, and you write another option.
Oh, of course.
Against your outstanding future.
Yeah,
okay.
Yeah. I'm just saying that in order to maximize the amount of movement in this contango, this 4%, to get this $30 move here, this would have to be the December 2009 option, because 4% is an annual number. If it's 2 months away, it's only like, 3/4 of 1%. But again, that might be enough. If you do it enough times in a year, you cover your storage costs, or you generate a significant income.
In fact, what Rudy is saying is, I think, the preferred way, because I think the shorter the time to expiry is, the better from the point of view of earning the income. Because you see, given a high enough volatility, the premium will be high enough. But then, since it's going to expire in maybe a few days, or at most a couple of weeks' time, your chance of pocketing that premium is so much better.
Yeah, this is a separate, there's a curve, right? There's a decay curve as to how time value of an option declines, and you want to be a seller at where it has the greatest gradient, and then you want to be a buyer when it has the lower gradient. So, if you really got very sophisticated about this and serious, then you'd buy the proper software and you'd price out all the option points, and you would buy it, wherever the gradient, probably looks something like this. You buy it in this range here, and I don't know what that is. It could be different in different times because it's volatility. Other things go into it.
My point is that it doesn't look attractive to me to sell that long-term option.
The 2009. I was only using this example here for the.
Yeah, but if you go out a full year ahead, then you are better off doing this, say, 12 times.
Right. True. That's a good point.
And since you have the cash gold.
Yeah, no, I agree. The other thing you could do is that you can exit these positions.
And since you have the cash gold, there's no expiry involved on the gold.
That's true, yeah.
But the more often you can sell against that, the option, probably your income has a better chance to stay in your pocket because it could so easily jump out.
I would certainly say that, yeah, I mean, it's December 2009. I mean, you really have to see if, yeah, that might be a little too far out. Any other questions? Sure.
But do you effectively have the gold if you have the future? Like if you do 1 month out on the option and the gold goes into money and you get the call and have to provide the gold to meet the option, do you have the gold in the future or do you have to then go and buy other gold? Does that future only come into play at the end of the 12-month period?
Well, let's just even back off to 12 months and just assume we can do this monthly, because I think that actually is probably the better way. But if this goes in, if this call option goes into it's in the money, okay, it's about $800, then yes, this is gonna what's gonna happen is you are going to be short on that day for December 2019, so November 26th. You can look in your account and you're not going to have a short call option, you're going to have a short futures. But since you have a long futures, they're going to cancel out. You're going to make the net difference, okay, the 5,000, 7,000, depending on where you are, or someplace in between those two numbers. And then you would have to, sort of quickly go into, replace this futures by going long to January and repeating it. But really, January is not even a month. That's a good contract month to use, so you probably want to be long February, okay? But you'd pretty much know that on the day, and you'd probably get a call from your broker saying, this thing is going into money. But actually, I don't even, when I do this now, they don't call me because they know one of my strategies is just let these things offset against each other. And then the next day, you just don't see anything, so it's all gone. But you would want to, you're right, you would want to then go long again. But unlike if this call option was in the money and you had physical gold, then you're right. What it would mean is you'd essentially have to deliver that physical gold and you'd get that price, $800 per ounce, but then you'd have to go out and repeat the thing, buy physical gold again, bring it back to the warehouse, get the warehouse receipt for it, and then repeat this. Doing it this way avoids that, and I wouldn't say that this is a method that we'd use for accumulation. This would purely be a method that you would use to generate income, and I would suggest that it be done at a point when contango is low. If contango is high, again, what you probably want to do is that spread that we talked about, long the futures in the spot month and short futures in the outer month. So this would be a strategy that you'd go back and forth on, probably using the same type of up and down, sort of volatility in the contango that we saw with Professor Draw on the charts on the previous page.
Can I make a comment?
Sure.
What you said is only one side of the story. The other side is you can buy back all those contracts by closing out.
Well, of course, you can use all sorts of...
And then if your positions is losing, you can stop loss, and if you're gaining, you can let your options, you can always let your money run, or you can buy back your call options and you square your position. You don't have to touch your gold.
No, yeah, and a lot of times what happens is that, let's say, gold has been at 750 for like 3 to 5 days, but all of a sudden now goes 750 one day, 790, 760, 780. It's just kind of oscillating back and forth.
You close out your positions.
This premium. Well, in this case, it would go up. That wouldn't be good for you. But let's say it was fluctuating. Maybe that's the other way to do it. Is if it's fluctuating a lot, and then it kind of settles down, this premium might go down. So you may want to buy back.
Yeah, that's right.
You may want to buy back this option at like $1,000 and just lock in that profit, and not take the risk that by expiration it goes into the money. So you do have more, obviously, options. And I'm simply saying that what the maximum is, and you can at any point in time sort of say, I've earned enough on this position. It's time to exit it.
Just using your example, no fancy work in between, let's say you hold it to expiry. Is your maximum gain here 7,000 and your maximum loss 3,000? I just want to clarify that in my mind. Is that the band possibility of just that covered short there.
Okay, well let's do something here.
And if it was, that's why I'm asking, if it was, just that would imply that you're expected gain, whether you're right that it's going to go up or wrong, is the premium you get. So
Well, let's take this example. Let's say it's 3,000. Let's say it was 750. Let me just modify this example a little bit. I think it'll help demonstrate and answer the question. Let's say I put a stop loss on the long futures position at 720. Okay, which means that if the futures price trades down to 720, I would exit this position. Okay. Now this gets tricky because then you have to put, as soon as you put the stop loss in, you'd have to put a position in to re-enter the market back again at 750.
Sorry, I was implying you don't do any of that. You just keep it for the spot.
No, but I just want to demonstrate that if you do this, okay, and then you have an entry back in at 750, you can't lose money on this position. Okay. So there is no loss if you sell at 720, as long as you reestablish a position. If you move up to 750 again, well, you lost with your commissions in effect. But you've already had this 3,000, you know. Well, right, you're right. You lose. Well, yeah, you lose the premium, but it wasn't, you know. I mean, you didn't have the premium to start with, so you're back at zero. So there is no total loss. I don't know if that. See what I'm saying? Because you set your stop loss at $3,000 below, but you earned $3,000 on the option. So you lost $3,000 here, but you had $3,000 in your account, so you've evened out. Now the problem is you still are short this call option.
When you sell it, you buy it back.
Well, then you've lost money. So in this case, you know, you would go long again at 750.
But you see, the point is that if you were sold out at 720 due to your stop loss, the call option is going to expire because it's nowhere near the strike of 800.
Unless it goes to 719, like it happens to me a lot of the time, it goes right to 719. I just had to stop. You know, it just goes $1 more lower, and then it reverses and goes up $100. I often think that I'm the one that's
moving it.
Okay. Sometimes it feels that way, but yeah. So, but I'm just trying to demonstrate that you don't, this really is money that it's like free money, okay?
Free money.
And it is.
I understand, yeah.
Because as long as you are going to be long 100 ounces of gold anyway, and are willing to let it go. I mean, you're hard long here. You're not going to trade this. This is 100 ounces you're going to keep until Kingdom Come. Then this every time you earn, every time you can do one of these things, you're going to earn money.
Provided
every
the
2 months.
gold goes up and you get called. No, if you might lose your gold if gold keeps going up.
Yeah, but then let's
keep your premium.
Let's say gold goes to 1,000 here. Okay. You're going to let it go to expiration now, but it goes to 1,000, and that may be one reason why you want to be pretty close. By the way, to just occurred to me because if this is a December 09 and now this thing is way in the money, you're going to wait probably until December 09 and let this thing, go into expiration. Of course, that might also mean that this thing goes back out of the money by then, so there might be an offset to that. But ideally, you only have a few days, so if it does go sort of in the money, you let this thing expire and and then you try it, you do it again, sort of, the next month. But in this case, if gold goes to 1,000, okay, you've made, let's see what you've made, $25,000 on the futures. You're down $20,000.
You still make 5.
You've made 5.
Less cost.
Plus 3, 8, right? No, yeah. So it doesn't matter if gold goes really high, you've still made 8. And then, okay, one problem here is that now when you buy your next futures back, you're buying it at, let's say it's 1,000, okay? So in that way, if that did happen, you don't want that to happen too many times because you've lost, in effect now, on that 100 ounces, the difference between 800 and 1,000. No, I mean, really, okay.
It could go the opposite way.
It could go the opposite way, and probably over time, this would not happen enough. But okay, that's not, okay, you called me on it, it's not a free lunch, right? I mean, you can't, it's not, there's no free money, there's always some risk that, something can happen, but again, I think if you do this the proper way,
any kind of this futures trading, you really need to be on top of your risk management. You need to be very careful about how you manage all of your money and all of your positions.
That's right. But I think this is a relatively simple strategy. Now, again, I would recommend that, a broker understand what you're trying to do. They might want to talk you out of it, but,
Tom, I have a question.
Yeah.
Suppose you have the basis charts which we talked about earlier today. How does that help you manage this strategy?
Okay.
If you have a basis chart.
Right. So
Do you get signals or exit points or entry points or what?
and perhaps you might be able to do that, but I was only approaching from the perspective of, recall earlier, we were saying that if you enter into a spread, a future spread where you're long the nearby contract and you're short the further out contract,
Okay.
and there's a 4% contango, let's say, and that contango shrinks, so you're making money there. But right now, that's not you couldn't do that. Now, 2 months ago, that would have probably been, in retrospect, an excellent trade. But now we're like right at even. And assuming we don't go into permanent backwardation, we're probably going to go back up into positive contango again. And so that's how I would say that this strategy would be more appropriate, or would be an appropriate strategy, to expect contango to sort of recover.
Okay. But in terms of signals,
I think you'd use the same type of thing. I think we had, see from here, so if you had the, the sort of the carrying cost or whatever here, with the base is positive, negative, right? And then you had it go like this, right? I would presume to say that, you would do it here.
you would sell the.
You would do this strategy. You would sell the cost.
No, you have the gold. That's there.
Yep.
You are not touching it. The gold is there. But now the question is, when do you write the call option? What signal are you waiting for when it's optimal?
If you want to put it that way, then I would say, and I don't think it's perfectly correct, but I would do the call option here, and I would do the futures here. Right?
Yeah.
Because this will contract back down.
Uh-huh.
So if you're short the futures, you're going to make money just by the compression of the premium in the futures.
Okay.
And here, since the call option is, doesn't have that contango component to it, it's still going to be against the strike price. You'll work this earning the upfront premium on the other
Okay.
end.
So you are not writing the call against gold, physical gold. You're writing the call against a future position.
Right. But I think what you said, it may even work if you have the physical gold. I mentioned it earlier too. It's just an additional step that if you did get, as you know too, that if this was this expired in the money, far enough in the money, you mean that you'd have to come up with cash, either sell some gold or allow this contract to be delivered upon.
But it seems to me you have two entry points if you do the future. You buy the future, that's an entry point. You sell the call option, that's another entry point. So you have more parameters to play with.
I think you do. And you can actually just keep the long futures here and change between being short the call option or short the futures on this end, depending on where the contango is. Again, intuitively I know that this should work. I just don't know really, is it as much money as I think it may be, because I haven't tested this exact strategy.
Sorry, Tom, there seems to be a correlation to me between the long futures price at which you're buying that at and the call option strike price. It seems that the long futures price must be smaller than the call option strike price. In this example, it is. That's what we provided. I don't know whether I'm reading too much into that as being significant in terms of generating revenue for yourself, or is there a case where you're buying long futures at 750 and you've got to call strike price at 740? I mean,
well, depending what the premium is, but if you look at an option contract, it's got I can't do it on a single chart like this, but there's a time value and there's an inherent value. And what happens is that an option that goes from out of the money to into the money, or vice versa, the premium a lot of the time doesn't change that much because the time value gets replaced by the intrinsic value or inherent value. Okay, so what you really want to pick is I think you're going to want to be out of the money. Okay, and you really are hoping, in a way, I mean, this is maybe a bad hope if you're long, but you don't want to have the gold price in those few days go up that much. You want the premium, this time premium, to sort of to go away. You don't want to go into have an intrinsic value. And the fact is, something like 90% of options expire out of the money. So, statistics are with you in this one case. Very few cases, that any retail investor. But this is something this is something you can easily, anyone can do. I mean, I've done this for 15 years. Not this exact same thing, but
it works in bear market.
Long futures and short, because
it does work in bear market too.
That's when it usually works the best. But I think even here, because of the contango, I think it may be a strategy that you can utilize while you're waiting perhaps for the other spread strategy with the contango returning to a higher level.
Tom, I understand that's nice for income, but if you want to recapture the contango, that is, if you expect it's going to go out, why don't you just short the nearby and buy the further out future?
Okay, because there's an unlimited, because we don't know that it's really going to go in this direction. If it truly turns out to be a permanent backwardation, as the professor said, 1 ounce of gold, if you're not careful, if you're net short for some reason, you can take an infinite loss.
Okay. So that's a lower risk strategy.
It's a lower risk strategy for essentially doing the reverse. I mean, if you had very limited risk, if you knew that backwardation for some reason could only go to 1%, remember contango in gold and silver won't go that high because people will buy gold and sell it forward to bring it back down. It's a risk-free trade almost, but there is no equivalent risk-free trade on the backwardation stuff.
If you put a stop, you limit your risk.
Limit up days, or
Okay.
So limit. I mean, I said stop here too, but typically, it's at some point you'll be able to get something close to the stop probably. You got limit up days or whatever else happens, the market goes and you'll pay $100,000 or whatever the next day. So you get filled at $100,000. It's not good.
Tom, are you actually going to have this detailed in a paper for your members so we don't have to write all this down?
The man with no pen.
That's an excellent idea. Maybe I should segue into here what I'm going to do as part of this service that we're launching. It's called the Metal Augmentor. Instead of writing it down here again, maybe Philip, when he sends out an email at some point after this conference with the PDF files of some of these things, we can repeat on there what the address of this website is. But it's going to be open, I think, for maybe about another month. That's the rate it's running at. I want to get about 400 to 500 people that are so-called founding members that I'm going to have sort of this lower rate structure that I'm going to try really hard not to ever change unless we get like hyperinflation. I'm trying to keep it as low as possible. In that equivalent, I mean, if I say $87, 6 months later, it's like $87 buys you a pack of gum. But I'm going to try, for these founding members, I'm going to try to keep it really low. The other thing I'm going to do is that, as I mentioned earlier, all the founding members will, there'll be a special email address, and it'll bounce to everyone else's email. So don't even, if you're not one, then we won't get it. But those will be the first emails we would answer. The service itself, just as far as the basis, is going to have some other components to it. Will involve sort of three different things at least. One will be just the sort of a alert flag or warning flag for when we're moving toward this permanent backwardation scenario, and discussion about it too, and why I think it is or why it isn't at a particular period of time. The second piece of it will be when I have ideas like this, or just generally making commentary about the market. We're at, let's say it's a 1% backwardation, and I'll be just generally trying to relate that to the price of gold or lease rates or whatever else. So just kind of a generic sort of commentary, running commentary on the basis. And then the third part will be sort of trading tools. There'll be charts that actually trade the basis or track the basis. I may or may not have mentioned certain trading strategies, like I might say, this is an interesting combination of futures and options, for example, for a strategy like this. And the other thing we'll include is, and if we have time tomorrow, I'll go into this, there are specific charts that I've designed that actually provide basis readings that are relatively time consuming to produce, but if I have paying members, I could do it every day. Each of you did it, might take each person half an hour, so that's a time savings for someone. So I'll probably have a few of those kind of charts, just sort of tools, so that you don't have to go out every day to to calculate the basis in all these different markets by yourself. Okay.
But you're going to offer trading advice.
I'll try to stay away from offering trading advice. Yeah, it's because I don't know. If I knew your specific situation, I was a licensed broker.
Yeah, it's different.
I just don't believe that one size fits all.
That's called metal augment, or is that site?
Yeah, metal augment. Or I probably write it big enough here. Let's see. All one word. I'm just putting this on the second line so people don't see it. With an O over there.
What about Silver Axis? What about Silver Axis?
.com. I'm going to keep I'm going to keep sort of talking about things there, but I'm not going to get into very specifics. I'm not going to provide charts and tools and all these other things. So, and it probably realistically, I'm not going to be able to provide the same level of commentary that I have over the last couple of months. And I kind of got a little out of control. So, but it may be something that once a day or every other day, which is kind of what I was doing about a year ago. I do want to keep that up though, because I think it's sort of the public sort of face of things. But this will be the website. If you go there now, basically what you have to do is you pay $87. You get this report that talks about that's up to 100. We found 100 different mining companies, not Australian ones. We're planning to get to it, but we've already found 100 just looking at the U.S. and the Canadian ones, where these companies are trading at a significant discount to their cash position. So that's sort of the first thing we've done. But again, once this thing is fully launched in the next few weeks, my main emphasis will be on the basis and a further development of some of the commentary that I've run on the Silver Axis site for the last couple of years.
All right. This is the end of the afternoon session, and I think it's been very informative. And tomorrow we'll gather again. There's no photo. If you didn't look good today, you're not going to look good in the future. This is it. See you tomorrow.
Can I just say one thing? And just for a couple of people who talked to me, I'm just going to stay back and go into how the Perth Mint trades with bullion banks unallocated. I mean, what happens when you ring up and buy? I mean, how do we fund this value chain? It's going to be involving debits and credits. It's going to be boring and technical, and there's no profit opportunity, unlike what you've just heard listening to it. But if you're interested in the accounting mechanics of how we actually operate and trade, which will go some way to explaining how bullion banks use and how we use unallocated metal accounts, and indeed how this sort of leasing and stuff works, then in a couple of minutes, 10 minutes, I'll go through.